Keys to the Commonwealth, a podcast where we share the real stories of local community members who are using real estate to build personal wealth, along with tips and tricks from professionals across the industry. And now, your host, Landry Fields.
Well, welcome back, everyone, to another episode of the Keys to the Commonwealth podcast. Today's topic is going to be a fantastic conversation about the topic that we all love to talk about, which is taxes. Yes, taxes, but obviously that's an important conversation, one we haven't tackled yet. My guest today is the president of Welch Company CPAs PSC. She has 23 years of experience and is originally from Sanford, North Carolina. She received her degree from Eastern Kentucky University and is married to her husband, Scott, and together they have two kids, Adam and Nate. It is my pleasure to welcome Stephanie Welch today to the Keys to the Commonwealth studio. Stephanie, thanks for coming on the show.
Thanks for the invitation.
I know you got to walk real far. Our offices are literally next door to each other, which is.
Yes,
I had a lot of real estate. Yeah, I had a lot of real estate clients like coming from like your office next door. I'm like, what are you doing over here? In my side of town. They're like, oh, our CPA's right there. I'm like, well, I've got to go meet her. So as we start up every episode, kind of talk to me. How did you get into the world of CPA and taxes?
Kind of funny. The and part of Welch Company is my dad. So okay. I swore, after seeing him burn the midnight oil on April 15th, head to the post office at midnight, and literally that I would never, ever do this. He needed some part-time help doing bookkeeping and payroll, and I needed a job. So I found out I was pretty good at it. Yeah. And liked solving puzzles and that kind of thing. Don't ask me to do math. Not my thing.
I've heard that from a lot of CPAs. Like, I'm not necessarily good at math. It's just, but you don't have. It's more about the.
Yeah, it's more about how do I get from here to here. Yeah. With the least tax impact. So it is a big puzzle. Yeah. And I do enjoy that. So 23 years later, here's where we are. 23
years. I bet it's flown by.
Yeah, it's crazy.
Right?
Yes.
I mean, and I'm in insurance. I never thought I'd be in insurance, It was not like it was the most sexy, appealing job at the time. But then sometimes you get into these careers, you're like, man, I really do enjoy this type of thing.
Yeah.
Type of thing. So
I started college out as a fashion merchandising major. So
okay, right. I started off as an engineering for like a semester and then quickly switched that major. Before we start into it, I know you got a disclaimer here real quick on that side of thing for legal purposes.
Everybody's tax situation is different. The things that we talk about today may apply to you. They might not. Just because there's a rule or a deduction available, it doesn't mean it's applicable to you personally. So talk to your own tax advisor. Find one if you don't have one. They really can be your advocate. But, these are generalities that we're going to talk about today.
Exactly. And if you don't have a good CPA, you should call Stephanie, which she will give her number here in a little bit at the end of the podcast. So invest in property, that's what we're here to talk about and discuss as it relates to the tax code and so forth. So what are some of the highlights of just owning investment property? I know there's a lot of CPAs say, even just if you had one or two type of thing, sometimes it's good for retirement or offsetting some of those things from different pools of thought, but yes. What's the broad overview to start with in some respects?
There are a couple of different tax treatments depending on how involved you are, how many pieces of property you own. So if you only own one or two and it is not your full-time job, you have a day job, for example, you're an engineer at Lexmark or whatever. Mm-hmm. Those rental properties are going to be considered passive income to you. So even if it does generate a loss, you don't get to deduct that loss. You can only go down to zero. Okay. You hold on to that passive loss. You carry that forward until you have passive income that you can use to offset that. Okay. So that's a lot of what we see. We have clients that own one or two pieces of property. They've bought them near campus maybe. They're just hanging on to them as an investment, and that's what they're going to use to supplement retirement. Yeah. Perfectly fine and a good strategy if you want to deal with, the maintenance and the upkeep and that kind of stuff. Right. The other client that we see, there's not really a whole lot of in between. It's more, we have one or two properties or we have a ton of properties. And that is, a professional real estate type person, whether they, like some clients, they own, 60, 70, 80, 100 doors of rental property. This is what they do for a living. That then becomes active income. We deduct losses.
Yeah.
We do all of those things that you do in an ordinary business.
And then what if you're like me and you're probably somewhere in the middle of that?
Well,
In some respects.
Like with you, what we talked about
Yeah.
before we started recording this, you've got an investment property
Yeah.
and a partner who's in with some of that. That's, there, we kind of walk that line. We make a decision based on how involved you are.
Yeah.
The number of hours, we'll talk about that in a
Yeah.
bit. The number of hours that you spend, the kinds of things that you do. There are some things that would automatically disqualify you from treating that as active income. So, if, for example, if you hire a management company to collect rent, to field those calls from the tenants about, the toilet is broken,
Yeah.
the IRS says you are no longer active. That automatically makes it passive activity for you because you're not involved in the day-to-day
No longer active
management.
for both of us if we did that kind of thing. Yeah. But as long as one of us are still doing it, as long as the entity is still doing some of those, it's still
Right,
considered. Yeah.
right.
I mean, speaking to that, obviously, if I remember right, there's 3 different kind of labels as far as part. You're not a real estate professional,
Right.
part-time real estate professional, and then more or less full-time. I don't know if there's a thing.
So the
Active
IRS
terms.
really kind of divides it in 2 big buckets.
Okay.
You either are a real estate professional or you aren't.
Okay.
And so the real estate professional, it's not a horribly difficult test to meet.
Okay.
It's based on the number of hours that you spend, the kinds of things that you do. Bookkeeping, for example, your record keeping, that doesn't count.
Yeah.
Actively showing up and managing it, calling the plumber to come fix that broken toilet,
Yeah.
or those kinds of things. Those activities count. Driving out and checking on it to make sure that
Right.
there's not any kind of damage from a hailstorm or whatever.
Sure.
Those things count as active.
Okay. So bookkeeping portion of it, even though you may hire it out, and it's okay. I was just.
I mean, you
making
can.
Sure.
And
so what is that
doesn't
rule
count to your
then?
hours.
Performed more than is it
750.
750.
Yeah.
Is there
And
a 500 one though? I remember seeing.
Yes, but the threshold to really kind of seal the
Okay.
deal for the IRS is that 750.
Okay.
Now, your spouse, her hours, his
Yeah.
hours could count towards that.
Sure.
Not the, clerical part of it, but, your spouse is out there going and
Yeah.
running a weed eater while somebody else is mowing, you've got that many more hours.
So I know that not complicates things because there's a lot more layers to that. Like you talked about
There
the
is.
puzzle, if like one's a real estate professional, another one is like me where you're an S corp, when you can kind of actually filing jointly, I believe, kind of offset some things on one side versus the other.
Right,
But
right.
my wife is not a real estate professional. She has no interest in that side of things to that extent. So, yeah, like I said, a lot of different puzzles in that sense. And then I assume part of that is just keeping track of a lot of hours spent, your details of kind of everything that you do, which is the best help. I'm sure you get a lot of people who show up and you're like, they have to go scramble to put a bunch of stuff together if they've never done this or never thought about it, or ask the questions up front ahead of tax season
Yeah,
and so
so
forth.
a lot of what we see are clients that come in and go, oh, by the way, I've got this piece of rental property that I just bought this year. What do I need to do? What you needed to have done is called us before you bought that rental property so that we could say, here's the rules, here's what you need to do, here's what you need to keep track of.
Yeah.
And so, we kind of hopefully steer them in the right direction for the next year so that, they are keeping up with mileage. They're keeping up with the amount of time that they spend. They're keeping up with all of those stupid little trips that add up, going to Lowe's to get nuts and bolts and air filters and then, all those things that you have to make a house work.
Speaking of keeping track of a lot of that, let's kind of switch gears here a little bit onto the depreciation side.
Okay.
And so keeping track of, I know, detailed, we've already started that, thankfully, as far as there was one of them, or a couple of them that we've been doing where we've been doing a lot. A couple of the units were already updated. We didn't much. The other ones we have and so forth. And so keeping track of per unit, what details have been put in as far as the cost and so forth. We've been keeping track of that, thankfully.
Okay, good.
And so talk to me a little bit about depreciation. What is it? How does it work on the short-term and long-term scales of things?
It's a real easy definition for depreciation. That is the method by which we account for the wear and tear and use of a property that's going to last, or a piece of equipment that's going to last more than 1 year. The IRS calls that a useful life. Residential rental real estate, the building itself has a 27.5-year life.
And that's just per the tax code, the way it's written?
Per the tax code,
okay.
Yep. If you're into commercial rental, that's 39 years.
Okay. I didn't realize that.
Yeah.
That's a good point.
So, but right now under the code, there is available for qualified improvements a faster write-off.
Okay.
So it has to be a 15-year life or less. And those kinds of things, think about appliances. Maybe a new hot water heater, washers, dryers.
Yeah.
If you're doing, if you're having to gut a unit and redo wiring, redo the plumbing, whatever,
like that, yeah.
Make sure you keep up with those expenses separately, because we can put those in different buckets, if you will. So 5-year, 10-year, 15, as opposed to 27.5.
Yeah.
In the long run, it doesn't really make a whole lot of difference, but the write-off, if we can put it in a 5-year bucket, is obviously faster than
Is there
27.
a quick and easy way to know which buckets, as far as a category kind of a thing like that?
So think about a leasehold improvement, like, putting up walls.
Okay.
Unfortunately, that's kind of stuck with a 27.5-year life.
Okay.
But the wiring behind that, the plumbing, that might be 15 years. We might be able to say that's a 15-year life and be able to write that off a tiny bit faster.
Okay.
Does that make sense?
Sort of, but wiring lasts way more than 15 years sometimes. That's why I'm like,
it does.
Interesting. Okay. So just keeping very detailed track of everything, which we've been doing. So here's what we had to spend on the plumbing and updating faucet things, or here's what we had to do for the hot water heater or furnace. I've started keeping track of when they were done each year on a property and so forth. So,
and that was an excellent piece of advice I got from a client. So, when we replaced our HVAC unit in our house, on the front of it, I wrote the date that we replaced it.
Yes, as insurance-wise, I'm always asking, how old is your furnace and how old is your roof on everything? Because each insurance,
important.
and it can go a long way on the insurance side too, I'll be honest, in that sense of knowing when those are done, including, especially on the commercial side, we write commercial policies, or especially if you start to get a book of business. I see a lot of clients that have them individually insured on individual policies, which is not inherently bad, obviously, but there's a lot more flexibility when it comes to commercial and saving of money and things. If you had one claim, where you could have one claim, but you only have to pay one deductible if it affected multiple properties on a big storm or something like that. Another conversation for another day. But in some of those respects, it can help even better because we can dive down into those things like the plumbing, the electric, and some of those additional questions that don't always get asked. So those are good points in that sense. But as far as the depreciation, so how does that work with offsetting taxes? And give me a real life kind of example. I purchased a property for $200,000. I put in $50,000 into it or something like that.
So the $200,000 that you laid out for the actual building, the structure, that is depreciable over 27.5 years. Whatever that works out to be, you take a deduction for it. Roughly. It's a little bit faster up front.
Okay.
And then kind of
I see.
Fades.
I see.
As you get closer to 27.5 years. Carpet, maybe you spent $10,000 on replacing carpet, which lasts, if we're lucky, 10 years. So 10-year life, we divide that by 10, and we take a tenth of that in addition to the building. Excuse me. That is a non-cash expense.
Okay. So which I'm not putting carpet in my rentals in one sense,
So some of those you just might want to take a hose to, right?
Yeah. I've got one right now with dog urine all over it that they just boarded this dog in the room for who knows how long.
That's disgusting.
Yeah. So we're taking that. It's LVP, but we're still taking it out. Yeah.
Yeah, start over.
Yeah.
So that non-cash expense, that just adds to all the other expenses, your insurance, property taxes, interest that you pay on the mortgage, utilities, whatever. Income minus all of those expenses, that's your net.
Okay.
Now, if you're passive, we just get to go to zero. If this is what you do actively, you're considered a real estate professional. If it generates a loss, we get to deduct that loss.
Okay.
The downside with depreciation is the potential recapture. So the IRS says this is a non-cash expense. Whenever you sell this piece of property, you could have to recapture some of those non-cash expenses. In this case, depreciation.
Okay.
Unfortunately, if you end up having to recapture depreciation, that's outside of capital gains, and it's taxed at ordinary income tax rates.
Okay.
Yeah, I saw the glaze.
So
I'm like, sorry.
I'm like, you gotta think through it even more in that sense.
You do. It can get complicated quickly.
Yeah, that's interesting. And so you're deducting that each year off of, and then how does that relate to if you're not? You said you're not a full time. It goes just to zero. But let's say if you do have losses, in that sense, with the property, how long can you continue? You keep doing that for 27 and a half years then, as far as some of the longer term ones?
It's pretty much indefinitely.
Definitely in that sense. And then how does that relate to, let's say, if you're, I assume that can fluctuate. For example, I might be 750 hours in it this year, but I might not be the next calendar year kind of thing. So I guess that could fluctuate sometimes.
And it does, and the IRS has taken that into consideration. So there's a bit of a grace for that. If it falls off in 1 year, so they tend, if they were to ever examine your return, they tend to look at it over a 2, 3, 4, 5 year span and say, okay, maybe it fell off in year 2, but year 3 and 4 was fine. Year 5 was pretty close, so we'll let it go.
Okay.
So there is some grace with that.
And then with the depreciation, I know there's something along the lines where you can have a detailed, kind of a sped up or advanced depreciation of some sort.
Right.
I forget what that's called specifically.
So right now, it's called bonus depreciation.
Okay.
So that's where that 15-year qualified improvement property for rental real estate comes into play.
You have to have a professional person kind of, from what I know, sometimes.
Not necessarily in that. So if what you're referring to is called a cost segregation study.
That's what I'm thinking of, yeah.
So that does have to be performed by a qualified engineer per the IRS's rules.
That would be a major undertaking on a property, not just cosmetic. That's
Yes, well, I'll give you an example. We had a client that built a garage.
Okay.
And we didn't want, he was a residential home builder, $500,000 homes and up. So he wanted a garage to put his truck, to put his skid steer, and to also have a showroom and all this. So, now we're talking about commercial property with a 39-year life, right?
Right.
So I suggested to him that he have a cost segregation study as he's building the garage so that we can have computer wiring and internet wiring. We can have plumbing. We can have the fixture side of things. We can get all those little buckets and be able to write things off faster than if we just simply said the entire building, which turns out to be was about $250,000-$260,000.
Yeah.
So instead of taking $260 over 39 years, maybe, I don't remember the exact numbers, but something much less, because we were able to divide that up.
Yeah. And so you're able to kind of help point to that sometimes of hey, this is going to be a better route if we can do this.
And it's really appropriate for somebody who's entertaining commercial property.
Okay.
To be able to come in and have that cost segregation study done.
Yeah.
And then say, here is wiring, here's light fixtures, here's whatever.
How does that relate in commercial if because sometimes tenants will, they'll have the grace or all clearance to improve the property themselves. But yeah, obviously they don't own the property, so that usually so how does that work in that obviously, again, another piece of the puzzle there, I'm sure.
It is another piece
when
of the
they're
puzzle.
the one that paid the expense for maybe the improvement of the commercial property as the tenant, but they don't own it.
Give you an example of what I've done on my side of the office. I paid to have it painted, at least part of it, because first of all, it was ugly color. and second of all, we'd been in the space for 10 years, and it was time. It really needed to be painted and holes patched and whatever else. I paid for it.
Okay.
I get to deduct that as an expense, not my landlord.
Okay. Whereas my office here, they did all as a part of the lease agreement, they're doing the improvements and so forth. So they get
that deduction,
Yeah.
So when we moved, we've got a space across the hall too. He put carpet in that. Our landlord did. So he gets that as a deduction, and the paint and the blinds that I paid for, I get.
Gotcha. Interesting. Okay. Moving to more of a topic with there's obviously long-term capital gains, short-term capital gains. It can get things can look real nice in one picture, and then you start realizing, there's a difference between short-term and long-term capital gains, whether I want to keep a property I've just improved the value on versus holding it for long-term. So walk through details, obviously what those are, the differences between the two, and then maybe what to watch out for, or why maybe you might want to or not want to sell a property type of thing.
Long-term capital gains are just that, a year typically and a day.
And I believe long-term and short-term really apply to this. Anything with capital gains, right?
It does.
We're not talking just property
not just
too
property,
technically.
but stocks, bonds, whatever, any kind of investment.
Because we've talked about opportunity zones and the aspect of taking anything capital gains wise.
Yes. So you hold on to it long term. You get a preferential, at least for now, a preferential tax rate. Could be zero depending on all your other income, but probably less than what your ordinary tax rate is. Short term doesn't qualify for that preferential rate. So that could be a year or less. So you could hold on to something for 6 months, you've got a short-term gain. So those tend to be a little bit more painful.
And what are those percentages for?
So short-term is whatever your ordinary tax rate is. So, that could be depending on how much of a gain you incur. You could bump yourself up to the next tax bracket. You could go from 12 to 22 and have that much more income taxed at 22% rate.
Okay.
So those can be painful. But,
yeah,
if you call your tax preparer and say, I'm thinking about doing this, can we run some numbers so that I know what to expect? It doesn't hurt quite as much. Right,
that's a good point. And that's the relation sometimes. I'm like, if you're having to pay a lot of taxes or figure out things with that, that's probably because you're doing the right things in as far as gaining assets or money that you're making and so forth with business and so forth.
Right. And
so good problems to have.
It is a good problem to have, but you just want to manage it wisely.
Yes. Yeah. So short-term wise, if I'm looking to potentially sell it with, especially home flippers. I mean, we were talking a little bit about that. I mean, that's an interesting one right there.
Typically, if you're going to flip a house, by the time, even if you buy it on the courthouse steps for next to nothing.
Yeah.
Because that assumes that you're going to have to do a whole lot of work. So by the time you've paid for it, say you've paid $75,000 for it, you put another $50,000 into it. So now we're at $125,000. You turn around and sell it for $150,000. It's not a horrible amount of gain. Better than maybe buying it.
And the capital gain,
not having to do a whole lot. And
to clarify, again, I don't sometimes know what I don't know. The capital gain would be the additional 25.
The 25.
Right. Okay.
So just in this case, simply the difference.
Yeah.
But you're counting labor and materials and capitalized interest that you've had to pay while you've held that note, while you're paying on that.
That's true.
Because typically most people don't pay cash for those.
Right.
So, and then, that frees you up, that $25,000 that you've made after you paid taxes on it, that frees you up to go and buy another one and kind of just rinse and repeat.
Yeah.
And that's what, the clients that we have that are doing the home flipping, it's what they do.
Yeah, it's interesting. And then one of the last points I kind of wanted to bring up was the way of legally structuring things. I thought they can change some things. Is there sometimes advice? Obviously, you're not a legal professional, but on it from the tax point of view or side of things, is there sometimes recommendations you have as far as people buying entities in their own name versus a rental property in the entity's name? Type of a scenario, or and that could obviously it's another piece of the puzzle. Here's an entity with just me, or just me and my spouse, versus me with somebody else that's not an actual household member.
Right. So in the case of the latter, where you've got another partner, and you all bought these properties, it's probably a good idea to have some type of LLC, some type of corporation, where you all are just at the end of the day splitting whatever that net income is.
Yeah.
And reporting that on your personal tax returns. The corporation doesn't need to pay its own tax. Let that just pass through to the shareholders, the partners. If you're going to own it personally, it's probably a good idea to go ahead and do a single member LLC. It gives you some additional.
I recommend it as an insurance agent.
Yeah, it gives you some additional legal protection. In the case somebody falls, has an accident, whatever the case may be, we hope that never happens.
Right. The idea is setting up layers of protection there, in that sense.
Exactly. Now, technically speaking, if you and your wife own a joint piece of rental property and you call it a joint venture, that's technically speaking, in the eyes of the IRS, a partnership. Practically speaking, I don't know that it's done that way commonly.
Sure.
Most of our clients have, just the one or two properties that we put in an LLC. We've got one client that has, I think she's got 7 LLCs with 6 or 7 pieces of property in each one.
And people do it different ways, I know, whether it's sometimes we will do an LLC for each individual one, or maybe they'll do 4 or 5 in one LLC and so forth, and things, which are good layers again. And then on the insurance side of things, we can better protect with an additional layer of an umbrella beyond that. But definitely umbrellas are recommended, because that's a very cheap way of preventing massive loss on your end type of thing. So that gets a little bit different. Obviously, if you own rental, you can still have a personal. There's definitely a difference, just as an FYI, between personal umbrella and your commercial umbrella. And so, you could have a couple different layers, even if you got a personal one for one thing, your personal stuff, and the commercial one on another layer side of things as well. And then we would have to speak to a lawyer more about layering different entities within entities. But
yes. But
those are good problems to have once you're getting
it's a good
level.
idea always.
Yeah. I'm thinking about wraps it up for the most part. I think one of the last questions is, again, as we're taking profit off of, let's say, me and my business partner, for example, and, our distributions to ourselves, that's the part we're talking about as far as real estate professional, back to our earlier conversation, right? Is that correct? Mm-hmm. As far as that goes against so we're talking kind of two different things. In one sense, the entity taxes versus sometimes your personal taxes.
Right. So if you have a partnership or an S corporation, both of those are what's referred to as a pass-through entity, so that the net income is passed through to each of the shareholders or members based on their ownership percentage.
Yeah.
So, 50-50, 75-25, whatever that is. And then each member shareholder picks that up via a form called a K-1 on their personal tax return.
Okay. Yep. I'm familiar with the K-1, being an S corp myself on that side of things. So lots of different pieces of the puzzle, and every single just for me, it was insurance as well. Every single person's portfolio or whatever they're doing is different and unique to them. So I know it's the same thing, and there's general guidelines, but that's why talking to somebody like Stephanie here is a must. Yeah, I think for any real estate investor. If you were to sit down with anybody that's kind of newer to it or thinking about getting into it, any other piece of advice that you would recommend that we haven't touched on?
You need a good attorney.
Okay. Yes.
For all of those weird, unforeseen things, help you structure some of this, just give you sound advice. You need a good insurance person so that that you feel comfortable with, that you can get good advice, and somebody that's going to look at you and say, that's probably not the best idea. You need a good tax preparer. so that, when you're going through this, not just short term, but long term, how do we structure things? Do we put it in this LLC? What happens when I want to sell it? What are those capital gains going to look like? Do I want to entertain something that we didn't talk about, a 1031 exchange, and switch properties to maybe avoid capital gains tax? So.
Yeah, we talked about that a little bit with a previous guest and so forth. But all different layers, and that's what we've talked about a lot of times as far as your team. Your team could also be people that are, plumbers, the HVACs, the people who are helping you in that side of thing. But your team can also be, again, your insurance, your tax, your legal, and having all those pieces of an asset in place is what you want to have, and you don't want to take that lightly or want to be scrambling last minute. Like I'm sure you have to work with people a lot of times.
Right.
They're scrambling.
You want to surround yourself with professionals and people that you can count on, because you can't possibly know everything.
Yeah.
And it's just working smarter to have people that you can count on.
That's great. I appreciate that. Some of your personal stuff, you had an interesting, what was your favorite concert you attended? It was an interesting story I think I heard about.
It was one I was personally involved in. I had an opportunity to go to Italy with Asbury Chorale. Our oldest son is an Asbury alum.
Okay.
And got to sing, so we were able to sing at the Vatican and sing one of the pieces that he composed as well. So just,
wow.
The experience of a lifetime. It was just amazing.
My wife's one really bad for us to go to Italy, type of thing. And so
you need to go.
It's on the list. We're starting to get out of that where the kids are so young that it was hard to go. So it's now kind of opened up a little bit. We're like, maybe we can start dreaming about traveling a little bit more. And
it was amazing.
Type of thing. Yeah.
So we spent some time in Florence.
When was that?
Time in May of 2019.
Okay. Not too long ago then.
In Rome, and then in a little town called Palestrina. So absolutely amazing.
What are your favorite things about Kentucky, not being from here originally?
I think the mountains. My parents are originally from the mountains, and it's just beautiful.
I don't think people think of Appalachia a lot of times when they think Kentucky if you're outside of it.
I know. The bluegrass is amazing, especially in the spring.
Yeah.
But nothing beats, that first little glimpse of the mountains in the fall when all the leaves have changed color and everything.
If only it would last more than like a day. I feel it's like you got one weekend,
that's all we get.
And then you're like, I missed it.
You missed it. Sorry about your luck.
Sorry about your luck. Any side hobbies or things you're working on, though, this year?
Things I'm working on this year. Our gardens are out.
Yeah.
So
we just took up gardening, too. A little bit. My wife did, I would just say. Yeah. We quickly learned that you should pick zucchinis at a certain point before they just continue to grow.
Yes. So did you grow up with Veggie Tales? That's what we always refer to the big giant ones as, Mr. Nezzer.
Yeah. So it's what it is. If anybody wants to get a hold of you to talk all things taxes with real estate investing or just their own personal taxes or so forth, what's the best way to reach out to you?
They can email me. My email address is swelch@welchcpas.com. They can call the office, 859-224-8909. But love to talk to them. Love the opportunity.
Absolutely. Stephanie, I appreciate you taking the time to come over to talk all things taxes, and I appreciate everybody listening. Make sure you're subscribed. Come back next week for another episode of Keys to the Commonwealth podcast. Stephanie, thanks for coming.
Yeah, thanks for having me. Appreciate it.
To learn more about this podcast, visit our page at keystothecommonwealth.com. To connect with Landry regarding insuring your investment portfolio, email landry@novainsuranceGroup.com or call 859-687-2004.